Hello everyone, welcome to another Reuters Events webinar. Today we're talking about stranded liabilities and stranded assets. This webinar has been brought together by Carbon Tracker Initiative and Reuters Events. It's being hosted today by Shadia Nasrallah of Reuters News, and I'll hand straight over to Shadia for the introductions and for the webinar.
Hello and welcome everyone. My name is Shadia Nasrallah. I cover oil and gas companies for Reuters. With a focus on the intersection of oil and climate issues. Welcome today for this session on stranded liabilities, which we hope will run for about an hour and a half. We are going to talk about a big funding gap in the cost of retiring oil and gas assets and potential financial solutions to this, and who's ultimately going to be on the hook for this, and will hopefully shed some light also on how we got here. We're going to talk a little bit about regulators. Are we looking at a big regulatory failure? The fact that this has not been pre-funded before? And how can lenders and investors make sure that there will be adequate funding once we stop producing from those assets? I'm going to talk you through the structure of today's webinar a little bit. We will have two presentations today, about 10 minutes each. We'll kick off with Greg Rogers, who is a US attorney and also a senior advisor to the Carbon Tracker Initiative and has written very detailed reports on the topic of what he calls stranded liabilities, i.e. The problem of the funding gap in oil and gas decommissioning. And then we will hear from Julien Alphon, who's the head of pensions and corporate solutions at BNP Paribas Asset Management. After those two presentations, we'll move into a panel discussion for about 30 minutes, and in the panel discussion, will be joined by Natalie Wallace, who's the global head of ESG strategy at State Street Global Advisors. And we will also hear from Krista Castañeda, who's a lawyer and currently standing as a candidate to join the Texas Railroad Commission, which is obviously the regulatory body in charge of the US shale patch. We'll then wrap up with the Q&A, where hopefully we will be addressing most of your questions. There's a Q&A button at the bottom of your screen, so please introduce yourself and write your question in there, and I'll try to get as many topics as possible covered in the Q&A session. So now let me introduce our first speaker today, Greg Rogers, who's a senior advisor to the Carbon Tracker Initiative. Greg will talk a little bit about stranded liabilities in the US shale industry. He has co-authored Carbon Tracker's latest reports on the topic, and we're talking about decommissioning costs, how nobody knows who's going to pay the bill, especially at a time when a lot of producers are facing bankruptcy, and there's general crisis in the industry due to falling oil prices and the energy transition, and how, and Greg will talk a little bit about how US states can protect themselves against being left alone with those liabilities, and also how capital markets can deal with this problem. So I'm gonna hand it over to Greg now.
Okay, thanks, Shadia. I'm gonna try to put my screen share on. Let me know if this works. Okay.
Yes, we can see your screen.
Okay, great, thank you. Well, I'll get started then. Let's see. Okay, so I'll start with an overview here that it's our view that the conditions exist for a downward spiral in the financing of the US oil and gas sector. And I'll just run through this quickly here, hang on. There we go. Make sure I can actually see my screen. Oop. So that our rationale for this is that the oil and gas industry in the US, particularly the shale revolution, is facing increasing economic and regulatory headwinds. And that as a result of this, the US oil producing states are poised to inherit literally billions, really hundreds of billions of dollars in cleanup costs. And as a result of this, the states are going to have to act to protect their citizens and taxpayers. And waiting for bankruptcies which is happening now, is only going to make matters worse and put increasing pressure on the states as oil companies default both on private loans as well as their obligations to the states to plug and abandon existing oil wells. The states will have to take action to respond to this to protect themselves, and that is going to trigger a market response, which kicks us back to the first point about the increasing economic headwinds facing the industry. So the industry was facing, the US oil and gas, and I'm going to be talking about onshore primarily, but was facing headwinds prior to the virus, and also prior to incurring costs for plug and abandonment of existing oil wells. So only 4% of the shale wells drilled since the 2004 revolution began in the United States have been plugged. The industry was facing negative cash flow generally prior to this. And this is, so these plug and abandon obligations, they come at the end of the useful life of an oil well and represent cash outflows that produce no return. The industry was facing negative cash flows before considering those costs. The other dynamic that's going on is production decline rates in shale wells that are higher than forecasted, higher than anticipated, which requires continual drilling to maintain existing production and revenue levels. That drilling requires continual flow of capital, primarily debt in recent years, and that debt flow was tightening prior to COVID. It's tightening more now, as you can imagine. Finally, Joe Biden, presidential candidate in the US, has expressly warned that the industry is going to have to pay for the cleanup. So a bit of a surprise, but plug and abandonment obligations have actually made top line billing in a potential future president's climate strategy. What this is doing is the economic stress on the industry is pulling forward in time these end of life closure obligations. We've got roughly 2.6 million onshore wells in the United States that are documented. And we're talking about, and this will be coming out in this new report, just under $300 billion is our estimate just to plug these wells. That's equal to 25% of the US oil industry market cap. And that includes some large companies with offshore assets and international assets. So I would say it's even worse than that. Now this excludes another estimated 1.2 million legacy wells that are undocumented that the EPA estimates are not in the current registry of documented wells. Looking at the industry's performance over the last 120 years, going back to 1900, at the current pace or historical pace of plugging wells as they're drilled, it take 300 years to plug these 3.8 million wells, just again, onshore US. So the bond coverage for this is less than 1%. The bonds are a form of financial assurance held by US states and the federal government to ensure that these end-of-life plug and abandonment obligations are actually paid for. Ideally, the bond coverage would be 100%. Our findings is that it's less than 1% of our estimates. Why that happened? There's been a regulatory race to the bottom over the period of the oil industry's prominence in the United States, with states competing with one another to create favorable business environment for oil companies. Requiring lower bonding is one of those ways. What that's resulted in, though, is just billions of dollars in interest-free, unsecured credit from state governments and the federal government to the oil industry. Those states are going to have to act to protect their citizens. They're in a deep financial hole. We've got wells that are, many legacy wells that have been closed for a long time, idle wells that have been closed for long periods of time, and then a new spate of shale wells that have been closed down post-COVID. We've also got a long history of larger firms selling marginal and late life assets to smaller firms that don't have the capital, in many cases, to pay for the closure. So we've got a finite and shrinking pool of industry assets that the states must compete for. They're competing importantly among themselves and also with private lenders in the capital markets. This raises the question of where is the money going to come from to pay for this? The US Congress is currently considering options to provide federal funds to the states for plug and abandonment, but those funds are likely to come with strings attached. There's a House bill that was passed in July, for example, that would provide a relatively small amount of money into the states to pay for plugging legacy wells. But the condition of that is that the funds will be prioritized based on states having full bonding of these end-of-life obligations. So from 1%, trying to get up to something closer to 100%. So waiting until the industry's assets are fully depleted is not a good strategy for the states. States have certain priorities. These are ongoing compliance obligations, so they are favored in bankruptcy. However, if there's no assets left, having a priority in bankruptcy doesn't mean much to the state governments. It's also the case that in some cases, bankruptcy judges will allow oil companies to abandon, so-called abandon, it's a double use of the word here, but to literally just walk away from assets that have no value. And in doing so, effectively walk away from the liabilities to plug and abandon those wells also. And so the lessons to the states is that they need to be proactive. If they wait around and don't do something to increase their security, the financial assurance or the bonding prior to bankruptcy, they can end up losing. And that's simply going to place more pressure on the states to take action to de-risk their exposure. Now, finally, I know this is a complicated slide and I don't want to spend a lot of time on it other than to tell you that it's featured in the first report that came out a few months ago called It's Closing Time. And the key point to take away from this is that the oil industry actually has two sources of capital and both of them are interconnected with each other. So the first that we think of is the private capital markets providing equity and debt to the industry. But another very important one is actually the state oil field regulatory system. It's providing, in effect, free, unsecured, or almost wholly unsecured credit for these end-of-life obligations to the industry that mount into the hundreds of billions of dollars. So the interaction here is that as the private capital markets start tightening credit, which has been happening, this increases the credit default risk to the states, the risk that the companies go into bankruptcy and can't pay for these obligations. At the same time, as the states start to react to this and they increase bond coverage, this is going to require higher bonding fees and more collateral from industry, which increases the risk of default, of credit default to the private capital markets. So this is similar to a snowball rolling down a hill. It seems like nothing's happening at first, but as that snowball gets bigger and bigger, it starts rolling faster and faster. So our view is that this dynamic could speed up very quickly and that it's already in process now. So with that, I'm going to turn back over screen control.
Well, thanks very much, Greg. I think that gave us a little bit of an overview of the situation in the US and the many unresolved questions in this patch. Let me now hand over to Julien Alphon from BNP Paribas Asset Management, who's going to talk a little bit about the financial solutions that a bank like BNP Paribas could offer, or the sector in general could offer. Julien designed strategies for institutional investors like pension funds and insurance companies. So he'll talk us through some options such as decommissioning bonds, pre-funding solutions. Obviously that might come in handy when cash flow is small or non-existent, which is becoming more of a pressing issue in the industry at the moment. And how can an asset manager basically help a roughneck go through this? And how can an investor make money from it? Julien, to you.
Thank you, Shadia. I just put on the screen my presentation. I hope everybody can see it.
Yes, we can see it.
Thank you. My name is Julien Halfon. I'm the head of pension and corporate solution at BNP Paribas Asset Management. And as Shadia just mentioned, I will be discussing financial solutions to decommissioning. In summary, is how you can try to find funds to pre-fund an investment reserve dedicated to decommissioning. And one of the points that Greg mentioned, but somehow more optimistically on my side, try to support decommissioning over the long term by capturing some of market returns. If we go further a few seconds, I just would like to summarize in really 1 minute why pre-funding is a good idea. First of all, as Greg just mentioned, many of those companies have now found themselves into a state of almost bankruptcy. So if they had put aside some reserve, some investment reserve in the past, they would be it would be for them a lot easier to meet the liabilities. Secondly, those costs that, as we all know, especially for offshore, but also for onshore oil and gas, and also for nuclear, for mining, and a few others, often have a large volatility. Onshore is potentially a little bit easier to calculate because you drill, and then you have some waste. You calculate what's the cost of treating that waste, matching that waste, probably easier. Offshore is more complicated because you need a boat, you need to go around the fields, and sometimes you have rights which are shared between different companies, so it becomes a bit of a headache. Next three points are really about corporate finance and why pre-funding is actually a good idea. By you deleverage and you reduce the pressure on your balance sheet, but you also create a situation where you can transfer rights on a field or on a well if you're onshore with less hassle of basically managing this liability that usually stays with the initial owner. In this case, it can be transferred with no problem. Finally, in a case which is more typical of nuclear, but we've seen exactly 10 years ago, something similar happening with BP. If there's a problem somewhere on an oil well offshore, there's a big catastrophe. If you have somehow partially pre-funded the decommissioning, you actually can face some increased cost if there's an accident or there's an issue. In nuclear, it's more after Fukushima, but also after Chernobyl, people decide sometimes to change their nuclear policy. So in all cases, pre-funding is positive. But in a previous intervention in end of July with a carbon tracker, we showed that it's actually superior to not pre-funding from a corporate financial standpoint. But now, let's look at what are the funding alternatives. How can you generate the required funds to pre-fund? So you have roughly three possibilities to fund your investment reserve. If you're really lucky, probably a bit less nowadays, you have some cash and cash equivalent on balance sheets. On balance sheet, those cash and cash equivalent are probably returning something like LIBOR or zero, let's say somewhere between 0 and 50 bips a year. It's not much. And in inflation terms, it's negative real yield. So you're actually losing money if you leave this cash completely idle on your balance sheet. It's probably a lot better for you to start to fund an investment reserve and get some higher returns. You can't really do this on balance sheet, and we'll come back to this in a few minutes. The other solution is that you can potentially issue a debt listed instrument, really go to the market and issue what we call a purpose bond that will be dedicated to decommissioning. This is really something that is gaining traction. It's part of the general energy transition process that we've been witnessing for the last at least 3-5 years, but we saw again a lot of momentum in 2019. We'll see if it's 2020 is not, with all the issues around the epidemic, is not going to sort of put a bit of brakes on that. That's good. That's quite a positive trend. Finally, this is a bit of a sort of the the glass half full or half empty. I would rather see that half full in this case. A lot of oil companies still have assets that have been underutilized on their balance sheets. Those assets often to do with property, sometimes patents, sometimes sorry, fleets of boats or cars or trucks can be securitized. We'll come back to this point also. This is something that can be used to pre-fund the investment reserve. Let's start with the liquid instrument, the issuing bonds. So let's start with the first one that I would like to mention is the traditional transition bond. You've seen more and more transition bonds coming. Last year, you've seen SNAM and Canada, and SNAM did even the beginning of this year, I think March, they've done an issuance on this. So you're really sending a signal to the market that you've decided to issue a bond that is going to be really dedicated to transitioning. So basically cleaning your past, your legacy problems. This is if your capital structure allows it. Again, quoting Craig's presentation, some companies may not be capable or able to, cannot afford to issue bonds now. But transition bonds have one big advantage. They are quite liked by investors. And we've seen in a number of cases issuance being bought at a premium. That's really, really positive. The other possibility is to issue KPI-linked bonds. So really bonds that have a number of triggers that can reduce, increase the yield that is offered by the company, but paid by the borrower, if targets are met or not met. In the case of decommissioning, it's pretty simple to set up those targets because you know how many fields, how many wells you can decommission, and it's really easy to do a sort of calendar. If I've decommissioning closed down and completely rehabilitated 100 fields at the end of the year, my interest rate will fall from, let's say, 4% to 3.75. That's really a really good, I think, one of the best and potentially the most effective way to do it. The only issue is that for the moment, those KPI linked bonds have been more general purpose bonds. So they rarely have been sort of tasked with doing sort of cleaning the environment, legacy problems. They're more trying to like transition, more forward-looking by doing funding greenfield operations. This is where leads us to the last type of bond, decommissioning bonds, which haven't yet technically been issued, but we believe this is the next generation, the next let's say KPI or transition bond 2.0, the new next generation of the purpose bonds will be dedicated to decommissioning. As I said, you can really follow them, you can really clean the environment, and you really can have a sort of premium when you issue them. So they should become more attractive to a lot of oil companies which have the capacity to do it. Now, if we move to the next section, more real assets. So what do we mean by real assets? I just mentioned rapidly properties, patents, etc. But basically stuff that are on balance sheet that are technically not core to the business. I'm not saying that you should take your refinery and put it somewhere as a collateral to a bond issuance, but stuff, for example, maybe your headquarters, HQs, big buildings, and you've seen this a lot in pensions and pension funding in Europe. You've seen a lot of retail companies transferring the ownership or the management of their real estate investments to their pension funds. You can imagine exactly the same thing for real assets, to property, patent, more property than anything else. At the same time, you could imagine a slightly modified version where instead of transferring the ownership to an investment reserve, you are dedicating the cash flows, the revenues that you're getting from that real asset, balance sheet assets. Say, well, you know what? I'm going to dedicate those 50, 75, 100 million a year to pre-funding, to meeting the decommissioning liabilities. Why this is a good idea? Because you don't transfer the ownership to anyone else, you're not externalizing it, but you're actually showing the market that you want to do something as an oil company, as a gas company. Also very, very positive. Last point I would like to mention is that not, I would say, not all vehicles are born equal in this case. You have some vehicles that are potentially better to manage this sort of long-term liabilities. Like pension funds have been created, trusts essentially in the US, Canada, Ireland, UK, Netherlands, and some Scandinavian countries. Trusts seem to be a very good vehicle for pension funds. Likewise, for oil and gas companies who want to decommission, potentially externalize a good idea. Why taking stuff out of the balance sheet? Because As long as you have cash.
Yeah.
So 1 minute.
Apologies for the interruption. If you could wrap up in the next couple of minutes, that would be great.
Yes.
Thank you.
Thanks, Shadia. Yeah, balance sheet, you may end up having profit on the investments that will go through the P&L. That will be costly for you. So choosing external vehicle, be it a captive or trust. Trust is very similar to pension fund, but also what is used essentially for nuclear decommissioning. So it's already done by a number of nuclear entities. A couple also cover all companies, but captive is also done by many oil companies. So it's really good to transfer the asset into something which is slightly outside of the balance sheet and potentially more adapted to meet assets and liabilities, and potentially optimizing your P&L on an annual basis. This is in summary something. So a few ideas that I'm throwing here to help oil and gas companies think of what they can do. Happy to take questions when the Q&A session starts. Shadia, all yours.
Great. Thanks so much, Julien and Greg, for your presentations. I think we've covered a lot of ground already, and this has already given us a lot of fodder for our panel discussion, where we're joined by Natalie Wallace and Krista Castañeda. Natalie, again, as a reminder, is the head of ESG strategy at State Street Global Advisors. She works with a lot of clients to develop investment strategies in both public and private equity that obviously fit ever-growing expectations for high ESG scores. So she can tell us a little bit about the pressures that the financial sectors can put on companies to address this issue, but also a little bit about the knowledge gap that might exist among clients in the financial sector. So Natalie has also considerable experience in emerging markets. Obviously, we've been focusing on the US, but this is a global problem. And the financial solutions that we're looking at will probably also be global. And in her free time, she advises the French government on trade. Today, also, she will speak a little bit, hopefully, about the metrics and standards used in the ESG space to make us all a little bit more literate in this space. Obviously, it's a sector where there's a lot of flux. Krista is both an engineer and a lawyer, and has worked in oil and gas for 30 years. And her law practice focuses on oil and gas litigation, and she often deals with highly technical evidence. She's standing to join the Texas Railroad Commission, the strangely named shale regulator in the States. And if she's successful, she would push for more stringent application to avoid waste and abuse of natural resources. She's represented royalty owners, landowners, operators, investors, service companies. So hopefully she can give us a good overview over the different kind of stakeholders, especially in the US, and shed through that a little bit of light of who might eventually have to pay for this. So we have about half an hour for this, and I'd like to kick off the panel discussion maybe with Krista. Aren't we trying to close the stable door after the horse is bolted? Isn't it a bit too late to think about funding this now?
A little bit, yes. And the problem is probably far worse than the data suggests, just because the data at the Railroad Commission is antiquated, and realize that it has existed, the Railroad Commission, for 120 years, back when we spotted wells based on their location to the old stone signpost and not by GPS. So the data has not migrated well over the years, and we have a tremendous issue even knowing where a lot of these wells are. In addition, you know, there's a practice of playing at the margins with whether a well should be abandoned and incur the plugging obligation versus maintained as what we call a stripper well, where it continues to produce in nominal quantities, but it's simply more expedient to keep it producing than it is to incur the plugging obligation. And then we also get In recent times, the Railroad Commission just in May suspended plugging obligations for an extended period of time relating to its response to the COVID pandemic and the financial downturn of so many of these firms. So it's a real challenging problem here. Yes, the bonds are inadequate. The bonds and many of the financial metrics for application fees and the like at the Railroad Commission were set in the 70s and 80s, and we're still dealing in currency and expectations that better match historical conventional play wells and the costs that were appropriate to that period of time. So, but all is not lost. And during this panel discussion, I would like to talk about how we incentivize something other than just the plugging of these wells. Perhaps there is a way to recommission the infrastructure for better uses. And I think that's where we all need to be looking and what we can do to encourage that kind of an approach rather than a use and throw away kind of approach.
Right, thanks, Krista. I'd like to bring in Natalie at this stage to give us a sort of helicopter overview of her work that sits between clients with big and long-term investment decisions to make and this issue.
Thank you, Shadia. Thank you, Shadia. Can you hear me okay? Yes. Well, thank you very much for inviting me on this panel, and thank you very much, Julian and Greg, for really enlightening presentation. I think what we are experiencing with our clients, the asset owners who we manage money on their behalf, and with companies we investing is this I would say bottom of the iceberg has not been totally discovered and to say the least not assessed in terms of impact, both at the company level, at the state level, and at the capital markets, both equity and bonds. I would say on the fixed income side, both sovereign bonds and corporate bonds, given that there are many petrostates involved in this segment of the market. I would like to just briefly talk about our work and how we can help unveil the risks that not only is in the oil and gas sector, but also how other sectors are exposed as this unravels. First, I would say that we have built a data platform, climate-related data platform that encompasses several aspects. One is obviously carbon metrics. We talked about decarbonization. Most of the large pension plans and sovereign wealth funds, even now central banks, are really looking at how to really align with the Paris Accord objective, and thus that's a major part of our work today, is helping our clients to align with the transition to a low carbon economy. So that's the transition from a carbon metrics perspective. The second aspect is how can we identify opportunities, right? So we actually onboarded data sources based on identifying green revenues at companies. So that's something else to help investors reallocate these assets from at-risk stranded assets based on decarbonization and transition risk into the companies that are benefiting or actually providing capital to the transition to a low carbon economy and fostering that capital allocation. But the third aspect that I want to mention is both a tool that and a data that we have onboarded that really addresses this issue of how our companies are preparing for not only the transition to a low carbon economy, and in this transition, both current reallocation of capital, changing demand pattern on the oil and gas and ICE demand patterns, as well as the legal issue that could arise from this transition to a low carbon economy. but also looking at the physical risk, which is how our current weather patterns, such as the fire in California, flooding in the south, bushfires in Australia, how are the companies actually prepared for the physical impact of climate change? So to go to the next step is we use this into our investment side of the house, but also in our engagement side of the house. And that's important here. We are very much big supporters of the TCFD, which actually was just announced to be a mandatory guidelines for reporting in New Zealand. So we are seeing the regulation really moving very fast forward, and the TCFD, the task force for non-financial climate disclosure, is really focusing on 4 areas, especially one, which is risks, and how our companies actually preparing for the risk. And in that is not only stranded assets, but stranded liabilities. So that's something we have started to talk to companies about, is how do they actually have business plans in place to be able to address these issues. As we heard from Greg and Julian, I think we have just scratched the surface. I think the systematic risk is pretty large, as Mark Carney has highlighted in the past, not only in the oil and gas sector and companies related, and as we heard at the state level and taxpayer level, but also, you know, globally, with all these oil majors being exposed to somewhere in their assets to pretty impressive liabilities related to either plugging in or closing down or changing the way they operate in communities which have been emboldened by the impact of climate change.
Thanks, Natalie. I was wondering if maybe Julien or, well, any of you might want to talk a little bit about geographical differences and how one might be able to price the actual cost or the risk associated in different countries or different types of oil companies that have different risks. You know, obviously it's different for a major like Shell in comparison with a pure shale player. So feel free to jump in.
Can start. Just a couple of elements. We have seen in the last few years a number of countries like South Africa or Chile trying to really enact regulations which are a bit more stringent. So basically, as soon as you dig something out of the ground, you have to put money aside to make sure that you can fill the hole at one point, be it offshore or onshore. A number of other countries are changing the way they're looking at the financial guarantees, the bonds that was mentioned earlier, not the financial bonds, but when we talk about bonds, it's more like bank guarantees or surety bonds, which are more just pieces of paper. There's no money behind. Some countries, Australia, Canada, started to review the value of those pieces of paper. They would rather see cash being invested and put aside than just a piece of paper saying that in 5 years, some bank guarantees that that company will have the funds. But you do have an issue between large companies, super majors, which have the means to do it, and many of the small guys who have absolutely no means to do this. So you have in North Sea normally, the large companies are held more accountable because they often have drilled in a North Sea in the offshore platform. So normally the liabilities go back to them if in most cases. A bit complicated because the liabilities cannot be transferred, but they can be shared sometimes. So it's a bit more complex than what I'm explaining now. But a number of regulatory bodies have tried to put a bit their foot down and saying, well, it's enough. You can't leave something. I mean, nobody will, in their right mind, will accept to leave a nuclear power plant unattended once it stops operating. I mean, imagine the scandal if suddenly you have nuclear radioactive fuel waste being left just outside. I mean, that would be totally, there would be an outcry, and the public would really push people to clean this.
Yet that is the situation. And if we think about methane leakages, which we're getting better and better at detecting and measuring, that is literally the situation we're looking at with oil and gas.
Exactly.
That's right.
Sorry, Natalie, please go ahead.
No, that's exactly right. And we see the pressure all over the place from actually society, right? Which are putting pressure on governments and local authorities to actually, do something about it. I think that's a major change from the old years that Krista was mentioning. Is I think the local pressure is really increasing significantly, which increases the reputational risk dramatically for these companies and the local authorities. So we expect to see more and more of these challenges locally, which we were mentioning, the issue between, or what's the difference between the shale gas industry here in the US or in Texas and globally. I think these major are exposed, very exposed globally to local pressure, which are sometimes very hard to quantify, and thus from at the investor level or at the bank level. So we really need more transparency in that space and planning, really planning around what are the risks in which area, what are the probability of having to plug in and being forced to, or having a big bill coming your way because you haven't done the right thing. So that's something we need clarity on, and we need actually a lot of accountability and standardization on exposure of these risks. I think Julian's work is actually extremely important in that case.
How about
Oh,
please.
sorry. Yeah, sorry. Just to pick up on what Natalie said, in Texas, we do not have a state income tax. All of our state funding, and it's a huge state with a lot of people in it, is funded on other types of taxes, and approximately 15% of our state budget and a huge portion of our state educational system is funded on oil and gas severance taxes and royalties from production on state-owned lands. The pandemic shot a huge hole in our state budget. Our stranded assets, or P&A well plugging bond fund is greatly undercapitalized, as Greg and Julian both observed. And there's not going to be an easy solution for this anytime soon here in Texas. The companies are having trouble finding funding for their ongoing operations, let alone for their historical assets on their balance sheets. So, and I just want to clarify one thing. When I talked about recommissioning assets, I am not talking about making old vertical wells back into oil wells. I'm talking about ideas like geothermal. We could perhaps commission some of these well bores. We spent billions of dollars to lay this stuff. Perhaps it could be converted into geothermal power because the temperature differential is unique, and perhaps we could run those drives on carbon dioxide and recapture some of the carbon dioxide. I mean, I think what we need to collectively be focusing on is creative, ingenious solutions to the problem we have worked our way into. Engineering in the real sense, and not financial engineering, as much as we have to have the correct financial products to get us out of this mess. We've also got to have real technological solutions to put this infrastructure to other use. Pipelines the same way. Maybe they're going to start carrying desalinated water away from the coast and back into the Permian instead of carrying oil and gas from the Permian to the coast. Just some ideas, no solutions here yet, but some things I'd like to focus on.
Yeah, for me, piggyback on Krista, you've seen a number of offshore fields in California and Gulf of Mexico, and now starting in the North Sea, being transformed in wind farms. So it's quite interesting that you transform something which is extracting oil into something that actually produces energy directly. Other cases, you have natural reserves. I mean, because the pylons on which the platforms are basically relying have created a sort of a small ecosystems with undersea fauna and sometimes some fish also, and some weeds. And finally, you have in a few cases in Canada, you've seen more and more open air and mines which have been transformed in resorts, hotels, sometimes also lakes. But takes a little bit. Krista's idea of using the pipelines, I think it's fantastic. Except it takes quite a lot of time to clean the damage. I mean, just to give you an idea, a coal mine has usually, you have a river or a lake that's used to carry the coal out of the the mine, it takes up to 45 years to clean it. If you do it really actively, up to 200 years if you leave nature by itself. So yes, there are a lot of solutions, and hopefully, if you have the right funding, this is one of the ideas what we believe is really strong at BNP, is that if you manage to get the right funding, you can invest the decommissioning reserve, the investment reserve, into green and socially impactful projects. So basically, you've done something which was useful, but now the legacy risks, a lot of potential pollutions, you want to transform that into something which is positive, that is going to be, I don't know, generating renewable energy, that's going to generate jobs and potentially also forests in some areas. But it takes time, and it's unique technology. I mean, all of the processes to decommission offshore platforms rely on quite complex technology. I mean, it's probably one of the biggest or most extraordinary feats of engineering is to see those boats taking, basically cutting topside a platform. It's really gigantic endeavors. And but we're doing it. We are doing stuff like that. So I'd rather be.
Costs are coming down.
Yeah.
And costs are coming down. I wanted to say this is exactly why we put our database in place to really reallocate capital towards this new technology. And we want to see companies, basically what I'm trying to say here is that the capital is ready to fund this transformation towards these mega trends. It's accelerating over the last 5 years because we actually seen really quite positive performance at the difference maybe of the early stage of green technology. So this money is ready at the private equity level, at the VC level, but also at the large institutional level and public and equity and debt. And again, that's why we put this database in place to be able to, assess and identify and assess these companies that are actually moving forward. I mean, Total is a good example, even though they continue maybe to invest in some deep sea and assets that might be stranded in the future, but we see them turning into their allocation of capital towards the future trends, mega trends. The other thing I wanted to mention is that something that we haven't seen enough is market system level infrastructure and the key players in that infrastructure, especially the credit rating agencies. I think we're missing a big element here in this field is as we missed them before the financial crisis, the global financial crisis in 2007 and 8, is we really need them to get their attention into the liabilities here and what are the impacts on the rating, even of the large companies.
You feel that hasn't happened yet enough?
Absolutely not, yes.
One thing that I've seen in the questions popping up, thank you so much. There's a lot of questions, some highly technical questions where I feel like it might make more sense to ping the panelists directly afterwards. One thing that has popped up is basically an accounting question. How do these liabilities pop up on balance sheets? How does that differ in different geographies? Maybe Greg can talk a little bit about that to help us also understand what warning signs we should look out for. How can we become, a sort of non-operators, but sort of stakeholders in the sector, become more literate in finding the kind of alarm signals that should draw our attention to this issue on a sort of corporate level?
Right. Well, I'll take that one. So in short, the accounting regimes are very similar across the world between US generally accepted accounting principles and the international standards. And basically what you've got are these very long-term obligations where the timing of the cash flows in many cases is anticipated to go out beyond the end of the century, if you can imagine that. So we've got an industry with liabilities that are expected to be paid out over the next 80 plus years in many cases. So obviously the time value of money is important in that consideration. So these liabilities on the balance sheet, and they are shown on the balance sheet, typically as either decommissioning provisions in Europe or as what the US calls asset retirement obligations. And these are discounted numbers. They really should be, I would argue, discounted at the risk-free interest rate, but in many cases they're they are discounted at credit adjusted rates that are specific to the entity. Now that results in a paradox in which poor credits, companies that are less likely to be able to actually pay these obligations, discount them more at a higher interest rate so that the liabilities are reported at a lower value on their balance sheet. It's very confusing. So I would say from an accounting standpoint, these liabilities, even discounted over decades, are still quite large relative to the balance sheet of oil and gas companies. But two things I would tell investors to worry about. One is the underlying cost estimates. Our research on this suggests that there are understated by a factor of 2 or more in general. In other words, if I had to do this work today, what would it cost me to do it? And that estimate is difficult in many cases to come up with, but evidence suggests that these estimates are low. So the second part of it is the effect of the discounting. So what is this going to cost in discounted dollars? In many cases, that will equate to another 2 times factor. In other words, reducing the amount it would cost you to do the work today by half, because you're expecting to spend those, incur those cash outflows over the next 60, 80 or more years. You put those two together and the liabilities on the balance sheet may be understated by a factor of 4 or more if, and this is a big if those costs were to come due sooner than expected. And I just want to, back to your earlier question, Shadi, about pricing risk. What we're drawing attention to here is something we called asset retirement obligation, or ARO acceleration risk. That the risk to the capital markets is that these liabilities come due not ratably over the next 80 years, but that in the world, as a result of the energy transition and working towards net zero by 2050, these obligations may come due much, much sooner than investors expected, than companies expected, than state regulators expected, or that creditors or stockholders expected. And that there's a cycle here because the two sides of the capital funding for the industry are interrelated, that state response and private capital market response can feed on each other. That's a type of systemic risk because in many cases, investors simply don't have a handle on how large these liabilities are. And they're unaware that the states are the biggest creditor in this game in many cases, and that the states have political pressure to reduce the exposure to their taxpayers. So you've got a large, essentially off-balance sheet liability. Back to the credit rating agencies are not tracking this carefully. And so investors could get quite surprised as these liabilities accelerate, which of course is happening at the same time that the assets to which these liabilities are associated, those assets are diminishing in value. So they're becoming impaired or stranded, which in effect is reducing their expected useful life from 30, 40, 50 years, plus another indeterminate amount of time that they can sit there unused, but not closed properly. That this time pressure or the time frame for this could be compressed into say 30 years. So if you're looking at an industry that its history is to plug and abandon wells on a 300-year pace, and you have to pull that into 30 years, in other words, increase the rate of decommissioning by a factor of 10. That's not realistic. And if there's not efforts to get ahead of that quickly and plan for this, you're not going to see this on the balance sheet. And so investors are going to be surprised.
Can we maybe get a round robin call on how much, on any kind of estimates you have on costs in the areas or geographies that you look at, or globally? Maybe we can start with Julien.
Yes, we did a survey in the beginning of the year, and I think globally oil, please, it's published on our website, so I hope I'm not quoting the wrong number. I think it's $500 billion of oil and gas decommissioning liabilities. To be completely honest, I agree with Greg. The real number is probably a lot higher than that. And as Greg said, if suddenly we accelerate the energy transition, we have a lot less time to meet those 500 billion, 750 billion, whatever it is, the iron number is going to be in the end, because we're still building, we're still digging. So this number is increasing. It's not decreasing. Just
Any other estimates that you want to share on the panel?
I think Greg has, you guys have an estimate you mentioned earlier just for onshore in the UK or in the US of 280 billion, if I'm not wrong.
Yes, correct.
We had, it was done 2 or 3 years ago, and we had done a survey on that with various publicly available information from think tanks, including Carbon Tracker. We usually quote, and it's a rough number. I think we are very much all underestimating these exposure and the risk. And I think I want to reemphasize the importance of the value of money and the fact that these assets will be becoming impaired, or are in the process of becoming impaired over the next 10 years, not 30 years. And thus the asset value is really declining extremely fast. And thus the liabilities relative to assets is just exploding. We had a number of exposure to the capital market overall worldwide of a quarter of the capital markets equity side. So this is a major risk. Again, these are big numbers. I think we all, we will all have to be humbled by the fact that there are so many variables that can change, including, again, regulation that can really push this forward very fast.
One other notion that I keep thinking about is, obviously a kind of common theme along ESG investments, the question of engagement versus regulation, or other ways to force the hand of the producers. Where do we stand on that? Do we believe in engagement, or is that just not dealing with the problem fast enough?
I think we believe in engagement. I think the reality is catching up very much faster than the companies want to realize. In general, that's a general comment. I think some companies are very much ahead. And I saw a question. We've seen some companies starting to unload assets, right, and sell. I think this is the first thing to do. Now it's just transferring the liability to somebody else, but at least some companies are realizing that there's a lot of not only asset revaluation exposure and liability exposure that they cannot face. So that's at the company level. That doesn't resolve the problem at the systematic level, right? Or the system level, right? I mean, I think, yeah, Krista is.
Yeah. So in the United States, and particularly in Texas, there is a pretty free ability to divest assets and even to divest liabilities without any productive value attached to those assets. We see it. It's a little bit sub rosa in the shale patch right now, but it does happen, and I do think that counting these liabilities is a huge concern. I would just also contribute that even at the state of Texas, the amount that we require for plugging is probably 1/5 of the actual cost of plugging. So I don't know how these companies are reporting the liabilities on their balance sheet to the extent they are. It's probably understated by 80%. I don't think that we have even a very good handle on these shale play or horizontals, that can extend for up to 20,000 feet, on what the actual plugging costs are for true securing of the well bore. So I think those are some pretty great concerns, just from a microscopic level here in Texas. Even though Texas is big, there's a lot of other liabilities around the world, I know.
So let me follow on with that, because I want to make a point, again, back to the balance sheet. Offshore, almost every jurisdiction has joint and several liability. So offshore, you sell these assets off to smaller players. Those liabilities could come back to the companies. Onshore, generally, that's not the case. But California, for example, allows the state to go after prior operators back to 1996. Second point is any state can change that law anytime it wants to. And the states are effectively going to be in competition with each other because many of these operators operate in multiple states.
Mm-hmm.
So there's a limited finite pool of assets. That pool is shrinking. The smart states are going to get out and get their share sooner. Once they make the decision that oil and gas does not have a future in their state, they're going to start trying to recover as many assets as they can. That's simply being responsible as a state leader. I want to make one other point from an accounting standpoint. These secondary sort of guarantor liabilities, the liabilities that you have if the current operator of a well or facility ends up defaulting and the regulator comes back against you as a prior operator, no companies report any liability for that on their balance sheet. And so that could be another source of surprise, not to the smaller companies, but to the integrated oil companies, to the super majors. They have a lot of exposure there.
Maybe to the lawyers on the panel, is there a litigation risk? I mean, could, for example, a state in the US or a country that is not exactly swimming in cash, like Nigeria or Chad, could they sue companies to come up with the money to pay for this? Or has this happened? Like, what's the kind of litigation landscape on this in the decommissioning space?
So as a litigator, although I don't litigate in other countries, I litigate mostly in Texas, we don't have a comprehensive regulatory liability scheme such as what Greg was describing exists elsewhere. I think of it like a CERCLA type regulatory scheme that doesn't exist for this kind of a problem. So we don't have a lot of litigation risk for people who handled the assets, you know, at inception and then passed it off to another operator and passed it off to another operator. I liken it, these are brands that we have in the United States, but maybe you start out with an operator who has Neiman Marcus level values in terms of operating, and then it gets passed down to the JCPenney level, and then it gets passed down to eventually ending up at something below the dollar store level in terms of the attention that are given to these things. And Neiman Marcus does not face liability for that original well once they passed it off to another under a current state scheme. Now, it would take a lot for that to change in a place like Texas, I think, and including many, many more political cycles. But at the current time, I don't foresee a lot of tail end liability going back to original operators.
I'm seeing quite a lot of questions also on the kind of exposure, maybe this again, one for Natalie and Julien, exposure of institutional investors to existing credit facilities. You've got your RBLs. How does this all fit together? And how can the funds that you can still, the money that you can still squeeze out of your EMP business sort of cover the whole array of liabilities we're looking at?
Well, first of all, I think there's, as was mentioned earlier, not only there is a potentially underestimate, and people underestimate the amount of liabilities. But also often when you see analysts talking about equity or credit risks, they don't really understand where to put those liabilities. I mean, I've been on pension for 20 years before that, and I feel like I'm back 20 years ago when people didn't know where to put pensions as a risk. We are exactly in the same thing 20 years later, where now people don't know where to put decommissioning risks. And we tend to we readjust free cash flow, net debt with the risk of decommissioning. And suddenly you see the ratios of the companies that look potentially positive become a bit less positive, not to say sometimes literally negative. So you should already have a warning from institutional investors if you look at what a company is doing, you can see where that risk should be embedded into your analysis. Secondly, I think there's also a behavior. There's more and more. I mean, but 4 or 5 months ago, the TPI, the Transition Pathway Initiative, that represents, I mean, roughly an alliance of $19 trillion of assets, where the Church of England, but people also the Norwegian government pension fund are quite active, had issued a number of warning on oil companies which are not following the Paris Agreement, the Paris Accord. So there's also not only what the numbers are, but also what those companies have as a strategy for the future. We can really look at if people are putting their money where their mouth is. It's pretty much what I would suggest people to do. You can see in sort of if it's coherent and it's consistent, you're probably positive. It's not, or if the message is consistently negative, you should look at it. Finally, there's sort of the way people fund this. As I mentioned earlier, surety bonds, bank guarantees, usually they roll up for 1, 2, or 3 years max. And as Greg said, it's something that's was supposed to last for 80 years, and now it's been, if you look at the North Sea, it's more like 15 to 20 on average. So you have much shorter duration, much shorter maturity for the needs to pay those liabilities. So if you look at what kind of insurance is covering what, you can see again either consistency or no consistency. So you really have to look at this. So if you are investing in all companies, you can really see what they're doing, where they're going. Are they diversifying their asset base? You've heard a number of cases now where oil companies, gas companies have invested in renewables. I mean, there's been a deal last week, quite large in the US for 1.1 billion. So really large. I mean, many people have seen it. It happens all across the board. So you have an overall strategy, how long you have to pay back those things, what's going to be the revenues of those companies that need to pay back those liabilities. Can they walk away from them? I think politically is not going to be, I don't know, I'm not an elected official in the UK, but I would say it would be difficult to add another 25 to 30 billion pounds of liability to the government if suddenly people walk away from the North Sea. Maybe, I don't know, your guess is as good as mine on this. So I'm not going to venture to make any forecast on this. But if people have to pay, I think it's going to be through, I would say, engineering on one side, issuing the right type of instruments, finding the right type of assets to put into long-term investments so they can meet the next 15, 20 years. At the same time, changing their behaviors and investing in new asset classes and new investment, literally changing the balance sheet to get exposure to different risks. And I think that if people start to do this, and it's not too late, it's going to be difficult. It would have been easier 10, 15 years ago, but it's still feasible now because you still have instruments that can really help you fund those liabilities, I think.
What I would like to add, thank you, Julian. I just would like to, one thing is that I actually have been in the space of trying to to coordinate cohesive and comprehensive response with large institutional investors such as the Church of England and all these initiatives. What we have seen over the last 5 years is that rather than being one-on-one conversations or one investor with one company, we've seen now a group or regrouping of investors to really force the issue on companies. And so the pressure is tremendous. Julian mentioned TPI. There is also the Climate Action 100. I'm going to outdo you a bit, Julian. 47 trillion behind that. Aligning, and that's where we come to the global point here. Aligning large sovereign wealth funds, public pension plans here in the US, but also globally, right? So here we're talking about the CIC, we're talking about the Norges, we're talking about the Japanese. I mean, these are massive pool of assets who can see and really, without assessing the exact number, they can actually see the exposure they have as they are universal owners, meaning that they own a large proportion of the market cap of the world, of these companies. The other point I wanted to mention is it's not only institutional investors who are now, really aware and putting pressure. Again, too little, too late, yes. But as Julian said, we've never seen such a coordinated effort. The other point is the central banks. I think I really want to reemphasize how much this is a systematic risk. we're talking, the size of another global financial crisis. I need to reiterate this point. And so much so that there is now the Network for Greening the Finance System, and NGFS, that was launched, I believe 2 years ago, 1 year ago, with really large central banks in it, including the Chinese, the US. So this has become a major, it has now reached a level that we haven't seen in the last 5 years. Now I'm talking about transition risk, decommissioning, but all of this risk are now understood at the margin. Now we need to understand really what's the impact, to assess it and prepare for it. That's the next step.
Just one thing that I just want to, we're talking about numbers. Our estimate, and we know we're very conservative, is that mining, oil and gas, nuclear, and traditional power decommissioning is roughly 3 to 4 trillion globally. But we know we're very conservative. I mean, the numbers that Krista and Greg are talking, either at US level or even Texas level, we know probably higher than that. Just to give you an idea, that represents between 10 and 15% of the 2-degree objectives. So if we manage to find a plan to reinvest correctly the 3.3 to 4, 5 trillion, that would be, and invest to clean the environment on one side and invest into green investments, renewables, social impact, etc. That could be potential 10 to 15% of the efforts that are required to limit the global warming to increase by more than 2 degrees. That's, if we can link, I think we should link the two problems, and we should see that solving one can help solve the other if it's done intelligently with the resources we have. And we have plenty of resources. Let's be honest. When we look at but total institutional investors, I mean, all assets, I think it's about 100 trillion. So we have largely enough funds globally to meet those things if we do it properly. If the companies contribute, if they start to change their behavior, but also if we give instruments to investors. If companies issue green bonds, we know green bonds, transition bonds, decommission bonds are really liked. I mean, anything that's issued is literally disappears immediately because people, I mean, the Church of England would like to clean their own endowments and pension fund by investing in really sustainable and ESG type investments. So all investors want to do this. Every single manager, our company has now, by the end of this year, the next 3 months, all assets will be managed according to ESG principles. So everyone is making a lot of efforts. And I think that if we do this in a coordinated way, we can clean quite fast that legacy problem and prepare for the future. Because it's one thing to clean the past. We must make sure not to make the mistakes again and again and again. So I think that we have here an opportunity, if we do it well, to move forward and in a very, very good way globally, not by pockets, like it's been the case in the past.
What's the uptake though? What in your experience, or any of you really, of these sort of more win-win creative financial constructs that funnel investment into more sustainable projects that can then generate money to pay for the decommissioning of the less sustainable projects? Because I mean, again, as a journalist, maybe I'm being too cynical here, but it's not like the oil sector has been has that good a track record of allocating capital, and the recent unbelievably large write-downs this year are kind of testimony to this.
There's been a lot of progress. I mean, if you look at a lot of infrastructure equity, private equity funds, so they've been investing in renewables for 10, 15 years. You have plenty of funds, so a lot of money has been going there. You have private debt going into renewables, social impact. A lot of the semi-financing is now taken sort of supported by large institutional investors like pension funds, insurance companies. So I think there's been a change, and the financial sector has been better, I think, at negotiating those changes the last few years. I don't know if it's going to last, but I'm quite happy to work where I am because my company we're sharing the same values. So it's actually positive. I feel it's actually good for me and being able to say that in public. But it's also, I think, State Street is doing something good also in that domain. I think it's less now acceptable even for employees to work in companies that will not try to do good. It's difficult. Now you can see that a lot of investors are now selecting purposely the sort of right ESG rated company or the highly rated and the sustainable approach rather than the sort of potentially the less, let's say, the less well rated. In practice, though, I will mention this, returns are highly in the ESG sustainable world. If you look at what happens at the beginning of the year, the polluted, let's say, less clean sectors have underperformed massively the well-rated from ESG standpoint sectors in all equity markets and bond markets. So you can see this. There's been, I mean, at least since the beginning of the year. I don't know if it's going to last, but you see this. The investors' behavior have changed quite a lot. And if you are a member of a pension fund, you want the pension fund to pay you your retirement benefits, of course. But you also want to be sure that they're not doing something which, well, to be honest, if they do something which is not fully moral with the money, usually there will be a price to pay at the end. Investing in the companies which are not technically US sustainable, you can expose yourself to fines and to problems down the road. So I see nowadays a real change. I think there's very positive feedback from the markets. As I mentioned, green and transition bonds are usually snapped out immediately. I mean, people want to get their hands on them as soon as possible. So I think that maybe in the past, financial sector has not done perfectly, but I think that for the future, we see. I mean, I'm very optimistic. I'd rather be optimistic because pessimists can always tell you in the end, I told you so. But optimists can be a bit more positive on this. Sorry, Christopher.
Let me echo what Julian is saying. I sense a tectonic shift here in Texas, and it has really come here, I'd say, in the last 3 or 4 months. And I do think that the strong message that was sent and announced, but of course has been in the works for a while, with the large institutional investors saying no more to the oil companies, has and Exxon falling off the Dow and all kinds of related financial news has really got the attention of the oil companies, that they know they must do better, and in so much so they know that they probably need to elect a Democrat for the first time in 25 years in the state of Texas to stand for the Texas Railroad Commission. I smile about this, but it's true. I see it every day that there is renewed interest in the sector in getting to better on these environmental issues because they have to. I hear it, I see it, I can sense the change is coming. And has already started.
So let me add one piece to this. Most private investors are not going to think about the government as an investor in the energy sector, but in fact they are, because the governments are providing free and largely unsecured credit for these closure obligations, right? And they have a significant role to play in how that gets resolved. So effectively, government has been complicit in creating this problem from the beginning, and will have to be involved in any solution because, let's face it, many of the resources are going to come from federal governments that can print the currency to pay for some of this. But we're starting to see a blueprint for how this may unfold in the Democratic-led House of Representatives in the US. Back to Julian's point, what you don't want to do is continuing to make the same mistakes of the past. I think our government is starting to recognize that. So in addition to the incentive to try to push forward with the energy transition, you've got this liability issue. So US states, for example, are not going to have the money to pay for this when industry defaults in a major way. And if they're going to be looking to the federal government, as they are already today with the stimulus money that's coming from COVID, the federal government has then power. And that power is to say, well, yes, we will help you, but we're not going to continue making the same mistakes of the past. What does that mean? You're going to have to impose full bonding on new wells. I mean, at a minimum, right? We'll deal with the legacy is going to be harder, but if you're going to continue to drill new wells, you're going to need to fully bond for those. That's what we're seeing in this House legislation. So the quid pro quo for federal funding is going to be states, you need to start getting your house in order. So I would watch for that because it's going to be an interplay between the public capital markets and the private capital markets as this plays out.
I wonder also, and this is something that come up in a few of the questions, as some of the majors go more into petchems, is plastic at all on your radar in terms of liability? I mean, it's a bit of, I feel like it's sort of a little bit akin to the Scope 3 emission discussion, whereby, you know, you might produce the resource that ultimately then gets burned in a car as diesel or gasoline, or gets thrown away as a plastic bottle for water. But can you hold the producer of the original resource, i.e. oil, can you hold them responsible? Have you seen that pop up in any legislation or anything?
Personally, I haven't seen, but there are a number of sectors now being affected by the same problem. For example, dumps. I mean, waste management. You have decommissioning in dumps. When you reach the maximum capacity, you have to start to basically retreat and recycle the garbage simply. And it's becoming a big issue, but it's being managed exactly like decommissioning for other sectors. Chemical factories, a number of other issues there. But one of them is quite strange, is for wind farms. The propellers are actually difficult to recycle, but you have to change them once in a while because technology changes. You want something a bit more sophisticated to increase the power, or simply they're too old and they get damaged one way or the other. So you have a number of other sectors which are touching. Plastic is not the one I've seen, but pollution in general, as far as I know, most plastic issues basically end up on the sea, based on 10 rivers globally. So what I've been reading this on the UN, I think. So they are now more and more focused on the polluters themselves. So even if I'd say regulation is really only constraining for nuclear and maybe in a few other very specific sectors, the idea of cleaning the environment is getting around in many other areas. And following what Krista has been saying, I think fundamentally the change is that we were not, I don't think we were sophisticated enough, not only from technological standpoint, but also financial standpoint, to think of solutions in the past. Only in this nuclear, people have been trying to find something because, again, I mean, after a couple of explosions, I mean, it was enough. I still remember, as it was not even 17 when Chernobyl exploded, I still remember where I was in high school in Paris, thinking that the nuclear cloud, I mean, the radioactive cloud, stopped at the border of France. I mean, people could say that in the 80s. Now it's not possible. Now people know that those problems have to be managed, have to be treated, have to be faced with the arsenal that we have. And the arsenal is pretty, I think that we are well equipped. We have the technology is improving. We have the ideas, and we have, I think, more than that, we have goodwill. Everybody wants to do it. Between Natalie and myself, I mean, we're talking about most of the large investors on this planet saying, okay, we will do something. We'll do our share and we'll contribute. So I'm positive for the future on this. I'm less positive for what are the, let's say, unexpected consequences of some of the treatment. For example, if we do not feel correctly or manage the waste correctly, fracking oil, what are the consequences if we do it correctly? So I think that's why I like to also take our time to look at the best solutions there. I think we have more time than what people assess. I agree with Greg that all those these are becoming stranded and come closer to us in time. But I think we still have a bit of time to put the money aside, let it grow, and develop the right solutions for the next 5, 10, 15 years. I think if we do this in a sort of logical and well-controlled process, we can all benefit. I mean, I have 2 kids, 8 and 11. I would rather leave them something that works as a planet rather than leave them alone outside. And they love to be outside.
I mean, to come back to something Krista mentioned quite earlier, that some of our participants have picked up on, repurposing of wells, so a kind of technical solution on the ground there. So you mentioned geothermal. I wonder, in terms of CCS, we have some tiny pilot projects in the UK, got some bigger stuff in Norway. But how do you see, is this something that's going to take off in a world where carbon essentially is still far too cheap to make it commercial?
Well, I mean, I think of it like this. When you think of a sunk cost to plug a well for no purpose other than to remediate environmental concerns versus repurposing for something that would be productive and produce an income stream in the future, that to me sounds like where you all focus your time and attention. And it seems like there are many technical concerns to be solved in being able to do this, but I do think that it's entirely possible that we will develop the new technologies to remediate and to provide for, you know, a repurposing and a future income stream for these assets that are a drag on everybody's balance sheets and frankly a drag on the world environmentally. That's where I'd like to get to better here in Texas. That's kind of my phrase, is let's get to better. You know, we're not going to solve anything 100%, but we can certainly do better day after day after day. And that's what the climate, UN climate report last fall said we need to be doing, is really focusing on what we can be doing at the state level and the local level. That's where we're missing all the opportunities. So that's what I'm focused on.
I wonder though, if you had a massive carbon price, it would incentivize local operators better, I assume, to push to build these plants.
Yeah. Well, look, I think one of the unique things about being in a place like Texas is if there's money to be made, people will find a way, right? We have a legal structure that incentivizes rapid response and reinvestment. And I think in this sense, it might be an advantage to trying to get some of these things done more quickly. And I am not here to talk today about the benefits of carbon taxes versus other incentive measures, but I do think that provided that there is a sufficient income stream that's sufficiently tangible and can be quantified to a reasonable degree of probability, we will have people who want to invest in those things.
I just would like to add one thing. I think we talked about the environmental costs, the financial costs. I think there is the social cost, and not in a just transition. It's just this industry in general employs a large number of people. It has funded a large number of social work, the external benefits from having such an industry in a region has been well known. I mean, these are massive, they have massive impact, and these are considerations that states, local cities and counties will have to deal with. So I think there is, just to finish on, it's a unique perspective where you have an alignment between government, I would say private and public money, and how to look at the future and implement the right programs, the right incentives. As Christophe said, I think the incentives are clear and provide the right financial incentives. So I would like I wanted to add the social aspect to this transition and to the cleaning up of the past and repositioning for the future. I think this is actually a social imperative as much as an environmental imperative.
We've done about 1.5 hours. Thank you so much for your insights. I'd like to wrap up. Maybe each one of you could end on one sentence, one call to action, one key takeaway very quickly before we end the discussion.
I'll start with my tagline again. Let's get to better. We can do it. Do a little more every day and move in the right direction, and we will get there.
Natalie,
yes, I will jump. Well, I think we have, as I said, the tools in place to be able to reallocate capital. So we're just waiting for, not waiting, we're ready to finance the transition to a low carbon economy and to help companies manage this transition. So up to you.
Greg?
You want to go? It's up to you.
Well, I'll make mine quick. I would say that you can't manage what you can't or don't measure. Back to Julian's point. So to get to the solutions that the other speakers have talked about, we simply have to measure the reality in front of us, and we haven't been doing a very good job of that.
I can't agree more with what Greg just said. I just would like to add that we have all the pieces there. There is a strong will from the investors' part. There is the technology is there from the decommissioning side, the engineering side, and there is the technology from the financial side. Financial engineering also exists. So I do believe that if we can finally move on and really go towards the common goal of forgetting a bit of this last 100 years of oil and plastic and move on to the new technologies and do this by cleaning the planet, that would be a big win for all of us.
Well, thank you so much. I agree. One of my main takeaways is we can't sort of close our eyes if we want to solve the issue. There's more to the debt financially and otherwise of this industry than might be obvious from just looking at a net debt figure on the balance sheet. But I think we've had some positive impulses as well about some creative solutions financially and otherwise technically as well. And enough big money talking to say that they're there to fund this and to take on that challenge. So thank you so much, and thanks to all our participants. We've had several hundred. So thank you so much for taking the time, and have a good day.
Thank you.
Thank you.